In today's video, I want to talk about max funding your 401k in 2023 and to go over 6 tips to making sure that you're lowering your taxes today and tomorrow, and really to help you with the timing of everything as well, because this stuff I think gets overlooked quite a bit. And I was watching some other videos that were really just saying the 401k max contribution wasn't the way to go, and the reasoning was just wrong. So let's go ahead and go through an example, and then I'm going to go through these 6 different tips to make sure that you're doing it right. So for 2023, the maximum that we're going to put in or could put in to a 401k or solo 401k is going to be $66,000. Now, if you're over 50 or older, you can do an additional $7,500. In the year that you turn 50, you're eligible for that $7,500. So that's going to bring the total to $73,500. And the other lesser known limit is going to be 100% of your compensation. So let's say your W-2 is $40,000. That becomes your new maximum. So if it's $66,000 if you're under the age of 50, or $73,500 if you're 50 or older. So there's 2 sides to the 401k, and that's going to be the traditional side, and then there's going to be the Roth side. So the Roth side is going to be after tax. The traditional side is going to be pre-tax. And I'm going to break down how we can make these contributions. So the first number is going to be the employee deferral. So this is the amount that you choose from your paycheck to go into either the traditional side or the Roth side. And for 2023, that's $22,500. That is the max that we can contribute as an employee deferral. So it's $22,500. Then you're going to get a match. So let's say we're earning $100,000, 4%, then that would be $4,000. So $4,000 is the match, which is included in this overall contribution. Even though it's coming from the employer, it's still included in these numbers. So for that math, we'll bring that up to $26,500. That means we're going to be able to put in an additional, $39,500 into our plan in order to hit the $66,000 max. And that amount, that extra amount, is going to go in as a non-deductible contribution. Non-deductible is another word for after tax. So it's the same type of contribution that would go into the Roth side, but it's going into the traditional side. That's just how our tax code works. So we can do the remaining amount up to $66,000. Now, your plan has to allow for after-tax or non-deductible contributions into the plan in order for you to make them. But that's a simple fix. So just ask your plan administrator, ask your HR department. They'll give you the plan documents, and there'll probably be a paragraph in there that basically says you can make non-deductible contributions. So then you can make those after-tax or non-deductible contributions. And it's really in your best interest to then immediately convert them over to the Roth. Now, the reason that you want to convert them pretty much immediately is because any of the growth in there, if it sits in here, that growth will then be taxable. But because it's after tax, any of the growth that's in the Roth side, because that conversion at that point isn't taxable because you're making an after-tax contribution into the traditional side and then immediately converting it to the Roth side, any of the growth in there will then not be taxed. It will just live inside of the Roth 401k and it will come out tax-free. So that is why you want to make that after-tax contribution and then immediately convert, and do that as quickly as you can. So that's what you want to do. That's how you can max fund to get to the full $66,000. Now, I want to point this out. So I just went through this example, and before I even made this video, I was watching a bunch of other videos, and the first tip, the first point that I want to point out and make it known is that you have pre-tax and after-tax money. So I've seen a lot of videos saying, well, why would you put your money into a 401k just to reduce your taxes today if you're in a lower tax bracket today and you're going to be in a higher one tomorrow? Well, you have the Roth side over here. So this is going to help you tomorrow. This will help you today. This will help you tomorrow. In addition to that, it is tax diversification. So getting your using the traditional side, the pre-tax contributions into the traditional side today could help you qualify for additional credits and deductions, which I'm going to get into. The credits and the deductions, but this one will help you keep your taxes low in the future. But that's not the only thing. Fast forward into your retirement years, we don't know where taxes are going to be, what tax laws, what tax credits, anything in 30, 40 years from now or in the future, whenever your future is, we really don't know. So if taxes end up going up in a particular year or a couple of years, then we can use the Roth. And that makes more sense to use the Roth to pull more money out of there if the taxes go up. Otherwise, we can pull more money out of the traditional side if taxes go down. And that's a very real scenario. From one year to the next might be very different. Maybe in the year that you retire, you don't have the income. Maybe you're not necessarily withdrawing Social Security. So then maybe it makes more sense to take it out of the traditional side at that point for a little bit. But then all of a sudden, something else happens where it makes more sense to take it out of the Roth. And in all honesty, you're probably going to switch between the two. And you're really going to try and keep the money in the Roth for as long as possible because you do get that tax-free growth, and that's a huge benefit. But dollar for dollar, if you're in the same tax bracket, it doesn't matter. It doesn't matter where your money is because the amount that you would have paid in taxes actually stays in the traditional side, and the same investment will prove that it doesn't matter. So it really depends on your particular situation and your tax bracket, but that is what you have to consider. And since we don't always know, it makes more sense to actually have both. And inevitably, you're probably going to have more. Even with the Secure Act 2.0, where we can take this match, and previously this match could only go to the traditional side. Now, I haven't seen it updated in any 401k so far, so let me know in the comments down below if your 401k has this provision change. But for Secure Act 2.0, you can now request, if the plan allows, you can request a match to go directly into the Roth side. Otherwise, point number 2 that I'm going to make here are the Roth conversions. Is if the money's over here, that $4,000 is on the traditional side, you can simply convert it. You can convert anything that's over here on the traditional side to the Roth side. Now, this is what I want to point out, is Roth conversion timing. So if you put the money in here in any given year, the year that you're making the contribution could technically be after the year. Now, in most cases, if you're a workplace plan, you're going to make it from your paycheck. So it's going to end up in that taxable year anyways. But the year that you're doing the conversion is the year that it's also taxed. So the point I'm trying to make is if you put in money that's pre-tax into this traditional side and you do want to convert, you should convert it before the end of the tax year. Not when you're doing your taxes and saying, oh, you know what, let's do it. You can't do it retroactively. The actual transaction of the conversion counts for the year that the time of the conversion occurs. So if you made the contribution pre-tax for 2022, let's say, or 2023, and then in 2023 or 2024, you did the conversion, that's when it would count. So again, let me say that again. Let's say we made the contribution for 2023 into our traditional 401k, and then we waited until 2024 to do the conversion. That would be taxable for 2024's tax year. So it's important that you understand the timing of the conversions and the contributions. Now, usually that comes up more with the solo 401ks because you can make the contribution after 12/31 for that previous taxable year. But with the conversion, that occurs no matter what plan you have. The conversion occurs or gets taxed or gets billed, however you want to say it, gets taxed in the year that you actually do the transaction. The third point I want to make here is a true-up feature. Now, a lot of 401ks have this, but not all of them do. So if you're trying to hit these maxes, this is most likely going to come into play. Because what I see a lot of people do is, oh, I want to put a ton into my 401k, which either side it goes into. I'm going to put 10%, 20% of my salary into my 401k. Well, that match is usually based on a per paycheck basis, and it only goes up to say like 4 or 6%, whatever your match is. That could result in you not actually achieving your total compensation match for the entire year. because if you've hit all of the contribution limits, say the 22.5 before the end of the year, then you might not get the full match on your total compensation unless you have what's called a true-up feature. Again, go back to your plan document, same thing, go to HR, your plan administrator, and they'll be able to tell you and point out. Make sure you see it so you know, but they'll have a true-up feature. And what that means is at the end of the year, if you were one of these big savers early on in the year, then they'll come back and say, oh, they actually did contribute the full match, but we didn't give them the full match based on their entire year's salary. So in that instance, then they would make an additional contribution. Now, I have seen this as well a few times where we went to go ahead and make the non-deductible contribution, not knowing there was a true-up feature and they were eligible for it. And that deposit of the true-up feature actually put them over this full amount right here. Now, it gets fixed, but it is just a big headache in doing so. So make sure that if you have the true-up feature, that you're aware of the true-up feature, especially if towards the end of the year, you're thinking about doing a non-deductible contribution to your 401k. The next point that I want to make here that I find gets overlooked probably the most when we're making these contributions, because there's always a big push. I mean, if you go on YouTube to other videos and you're looking at the Roth side, everyone's like Roth, Roth, Roth all day long, you know, no matter what, Roth. Well, this doesn't help you reduce your taxes today. And a lot of times at the end of the year, it's just too late when you're doing your taxes to figure out whether or not you would qualify for any credits, tax credits or tax deductions. So those are often overlooked, and it's often too late to go back and say, you know what, I would have preferred to have that contribution on the traditional side versus the Roth side to bring down my taxable income, or not having done that Roth conversion when I thought it would be a good idea, but now all of a sudden I don't qualify for that additional tax credit or that additional tax deduction. So that is really important to pay attention to. So basically what I would do is I would go in and say, okay, well, where's your income going to land, or about where it's going to land, and then become aware of what credits or deductions are available to you. And there's tons of different reports and lists that you can look at in order to figure that out. But that's the difference between the traditional and the Roth. It's not just about your tax bracket. Don't just say, oh, well, I'm in this tax bracket, this is what I'm going to do. You have to look a little bit further to see if you qualify for it. The last point I want to make here is the roll-up tax strategy. And this is to avoid the pro rata rule. So let's say you're doing this whole strategy here, and you also have an IRA, a traditional IRA, and a Roth IRA, and you really want to max it out. So we want to put in the maximum amount that we can put into these plans, but the problem here is we would be subject to the pro rata rule if we're over the income thresholds to make a contribution directly into the Roth side. So what do we do here? We put it in the same way we did here after tax. We can do that same thing on the traditional IRA down here. We could put it in after tax and then convert immediately. And that is the backdoor Roth conversion. That is a strategy, a two-step process. So we're making the contribution here as a non-deductible contribution after tax, and then we're converting it. However, you need to be aware of the pro rata rule. And that basically ropes in all your traditional IRAs, your SEPs, simples, all those that gets roped in. And then you have to do a pro rata rule, which again could then increase your taxable situation and disqualify you from certain credits or deductions. So in that instance, what I would do here is consider, not always, sometimes it does make sense to do it, and that's perfectly fine too. But sometimes, and I like this strategy more with solo 401ks, just because you have more control of the investments. But what we can do here is take the money from the traditional IRA and then roll it up to my traditional 401k, and it avoids that pro rata rule. So when we make that after-tax contribution, we're not subject to the pro rata rule because the 401k doesn't get roped in and the 401k doesn't have a pro rata rule. So you can do conversions here, not worry about the pro rata rule. And then down here, you have to worry about the pro rata rule, but get that pre-tax money out of there by 12/31. So if you don't do it by 12/31, so again, one of these last minute contributions to your IRAs, which you can do, but if you do it this way, while this will count, the after-tax contribution will count for the year that you want it to, as long as you're doing it before your tax filing deadline, but that conversion will then, and the pro rata rule will then get roped in to the calculations because it's based on 12/31. So if the money was already in there, even if you do it after 12/31, it doesn't matter. It still counts as money that has been in there. And there would be a calculation, meaning not all of the after-tax money would get converted unless you converted all of it. So that is a way that you could get the money out of there into the traditional side. Now, if I had my choice, I would use a solo 401k all day long in order to do that. But not everyone has, a side hustle or a small business in order to do that. But if you don't, then that's what I would do. I would consider rolling it up if it's a lot of money in there. Otherwise, just be aware of it. Again, it's not the end of the world. It's not the worst thing in the world to be subject to the pro rata rule because you're saving. That's a good thing. And as long as you're not missing out on any credits or deductions, then there's nothing wrong with it. Again, you get more flexibility with your IRAs and a solo 401k as far as your investment options go. But either way, you just want to be aware of these things. So again, looking at the 401k, I like putting as much money as you possibly can into the 401k to really help your retirement in the future. And this idea that you can only put it into the traditional side, I don't even know where that came from, but a ton of videos out there basically are saying that because that's not new. So I don't know where it came from. Anyways, if you have any questions on this stuff, hope this helps. Let me know in the comments down below and we'll see you on the next one.